please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
We shift focus to a big CNBC TV 18 exclusive. Our sources tell us that the insurance regulator is in consultation with the SEBI to review the IPO rules for insurance companies. Yash Jain joins us with those details. Yash, take it away.
Well, absolutely. The insurance regulator has reached out to SEBI suggesting certain changes and amendments with respect to IPO regulations for insurance companies. To start with the first one, and this is with respect to diversifying and broad-basing the shareholding reservation pattern for the insurance IPOs. Here, essentially to reduce the concentration of risk and broad-base the shareholding reservation pattern, IRDA is likely to have suggested to reduce the QIB portion in any insurance IPO from the current point of 50%, and essentially then later on that reduced portion out of the QIB section should be distributed amongst the various other shareholding categories, be it retail, be it HNI, so on and so forth. The second and the most important point is with respect to the minimum public shareholding norms. Of course, we know that all the listed companies are essentially mandated to dilute 25% of equity in public within 3 years of listing. IRDA here has said that it's not likely and it's not ideal for any insurance company to transfer 25% of the risk in public within that short period of 3 years. Hence, a time extension should be given to the insurance companies as far as that particular dilution of 25% is concerned. If not a time extension, then the quantum of 25% should be reduced. If this particular point materializes in terms of any regulation, and if it is retrospective, then it will benefit a lot of these listed insurance companies, be it ICICI Prudential Life, be it GICRE, be it New India Assurance, as well as SBI Life and HDFC Life, as all these companies have a significant quantum which they are yet to dilute into the market to comply with that 25% public shareholding norm. The third one is with respect to raising debt via Tier 2 bonds. Right now, insurance companies are only allowed to raise up to 25% of their net worth via Tier 2 bonds. IRDA here has suggested to raise this particular limit, possibly take it to 40 to 45% of any insurance company's net worth.
Okay, Yash, thanks so much for that interesting story. Well, to take this discussion forward, we have Sandeep Parekh, founder of FinSec Law Advisors, who joins us on the phone line. Thanks so much, Mr. Parekh, for joining in this morning. One thing that I wanted to clarify and wanted your understanding, your take on this is in terms of the change in bringing down the minimum holding, public holding to around 25% in 3 years. What Yash's story says is that they're relooking that. Your take on that, will it be on a retrospective basis or will it be on a prospective basis?
First of all, my take is that I don't think there's a separate law required for insurance companies. Broadly, I think the laws are applicable. Everybody wants extensions for their own industry.
Okay.
Similarly, government companies say that this law should not be applied, and they've been actually been given a longer period of time compared to private sector companies. So I think this everybody asking that the law should not apply to them is kind of makes the situation untenable.
So Mr. Parekh, sir, you're saying that you don't believe that there should be any kind of exemption, first of all, for these companies in the first place. But if that comes about, then how do we look at it? I mean, will it be, some of these companies already listed?
Yes, so they're listed on the presumption that the law applies to them because the law is there. It says that within 3 years you need to comply with 25% minimum public shareholding. So they went with their eyes open. Now, nobody goes to a market saying that we may expect the law to change after 2 years. So I think that's not a reasonable expectation to have.
True. Right. Mr. Parekh, one of the other things that they're seeking, IRDA is saying that they are looking at reduction in portion allotted for QIP in insurance IPOs, which is currently 50%, to reduce that. Do you think there is merit in that case? Because all the other companies is the same. Is there merit for just insurance companies to reduce the quantum of the QIPs?
As I said, I think the law is, there's nothing unique about the insurance companies except for the fact that, as a matter of fact, they've had long gestation periods. But I don't see why the law should be, if at all the law has changed, it should be changed for everybody and not for one segment of the industry.
All right. And finally, a question before we let you go, Mr. Parekh. The IRDA, they're saying, may allow insurance companies to raise Tier 2 debt beyond 25% of their net worth. Do you think the risk reward, or is there any business risk to this demand, or maybe this is okay the way it is right now?
I would not really know in terms of how they rank tier 2. So I would not be able to comment on it till I see the fine print on this.